Hey guys, welcome to my channel. My name is Dylan and I'm a software developer by trade and a real estate investor by blood. Today, I'm going to be talking about how to get started in real estate investing. What if I told you that you could become wealthy with little money, little effort, and you could use other people's money to build your wealth? Well, in this video, that's exactly what I'm going to teach you. I didn't come from a family with money, so I had very little options to create wealth. But real estate was that option for me. And 5 years ago, I got started in real estate by buying a duplex for just over $560,000. And today it's worth about $1.1 million. And it's creating a positive cash flow of over $1,000 every single month for me. So this video is going to teach you everything that I know about getting started in real estate investing, how to find your deals, how to get a mortgage, what you need to qualify, and what banks look at when you're applying for a mortgage. And then I'm going to talk about being a good landlord, because that's one of the most important parts of real estate investing, being a good landlord for your tenant. This video will also be timestamped so that you can skip around or come back and review certain parts of the video. And this video is going to be more in depth than any other video on YouTube. I will have details that nobody else has put in their video, but are important to know when you start investing in real estate. So make sure you watch this video thoroughly to the end so you don't miss any key points. And if you know anyone that might be interested in learning or getting started about real estate investing, definitely make sure to share this video with them so they know everything that they need to know to be successful. And as always, like the video down below, leave a comment what you think, and subscribe if this content is valuable to you. So let's first talk about why I think real estate is the best method to start building wealth if you don't have a lot of money. Reason number one is pretty simple. To invest in stocks or any kind of investment, you generally need a lot of money to make any kind of money. For example, you might need $1 million just to make $50,000 every single year in passive income. However, with real estate, you can get loans with very low interest rates, especially today, and low down payment options. I got started with a FHA 3.5% down payment loan, which meant I only had to put down about $20,000, and that allowed me to buy a multifamily that I've made over $500,000 in appreciation on, and overall my net worth grows by over $100,000 every single year. And not all real estate is going to appreciate like that, and I'll talk a little bit more about that in this video. However, on average, real estate will appreciate by about 6% depending on your market every single year. And you'll have cash flow and principal pay down on the loan. And with real estate, you're able to build equity on day one. The point that you make the most money in real estate is when you buy it. You have to make sure you get a good deal, which will be covered in this video as well. And then something else that I talk about and that I personally did, I house hacked my first duplex. I made a whole video on how you can do this, so check it out up above. But basically, house hacking is when you buy a multifamily property, you live in one unit and rent out the others. That will usually either cover all of the mortgage payment or most of it. Sometimes if you buy a 3 or 4plex, you can also make a profit every single month while living for free. See, I was able to buy a $570,000 multifamily at 23 years old, making only $40,000 a year at my job. I was able to qualify for this loan because it was a multifamily. I was able to use the rental income from the second unit towards the qualification for the mortgage. Typically, I would have only qualified for $250,000, but because I had other people's money through rent coming in, that was able to cover the difference. So that's another way that other people's money is helping you build your wealth if you do this right. So how are you building wealth through real estate? Now, a lot of people think that the only way you're building wealth through real estate is through the positive cash flow. However, while that is one key important part of it, there are a couple of other ways that you're building wealth. The first one is appreciation. This is something that adds to your net worth every single year that your property appreciates. And on average, properties in America appreciate by 4 to 6% year over year, accounting for a market shift every 10 or 15 years. But on average, they stay steadily increasing at 4 to 6%. Some markets may be higher, some may be lower, so you'd have to make sure to check in your areas. And then the second way that you're building wealth is through principal pay down. Every month that you pay down the loan, A portion of that is going to the principal amount of the loan and paying down the total balance of your mortgage. And if you're collecting rent on the property, that means your tenants are building your net worth for you. And the third way that I mentioned before is through positive cash flow. Now, if you're house hacking and you're not creating a positive cash flow, you are actually creating a positive cash flow if you look at it, because you're not paying as much towards the mortgage as you'd be paying in rent somewhere else. So you are saving money, and that can technically be a positive cash flow for your bank account. Now, if it's a completely 100% investment property and it is creating a positive cash flow, then that is purely profit for you. And then the last thing that I want to cover before we get into the 10 steps to get started in real estate investing, common concerns that I hear people say about being a landlord. A lot of people say, oh, they would never be able to have rentals because being a landlord is so difficult. Let me just assure you that as long as you have good properties, you maintain them, and you have decent tenants, then being a landlord is quite easy. And over time, as you build your portfolio, if you don't want to be a landlord, you could always hire a property management company as long as you've got the cash flow to support it. But in my opinion, being a landlord is 1,000% worth it. I might spend a couple of hours every single month doing anything related to my property. Outside of that, I don't even have to think about the property, and I'm collecting all of the benefits that I talked about before: appreciation, principal pay down, and positive cash flow. So if you look at my hourly rate that I'm making on this investment, I'm making somewhere between $4,000 and $6,000 per hour. I'd like to see where you're making more money for your time than that, unless you're Elon Musk, of course. So now that we've covered why real estate is the best method for creating wealth with little money, and covered the concerns, let's get started into the 10 steps of getting started in real estate investing. So step number 1, determine how you want to get started in real estate. Are you looking to buy a multifamily property to house hack and live in? Or are you looking for a 100% investment property that you'd buy and never live in? In my opinion, the easiest way to get started in real estate with a little bit of money is house hacking a multifamily property. That's how I got started, because like I mentioned earlier, I didn't have a lot of money to put down for a down payment. And when you buy a property as your primary residence, you can qualify for much lower down payments from 0% to 5%. I personally used an FHA 3.5% down payment program. One thing to note, if you put less than 20% down payment on a mortgage, you'll have something called as PMI, Private Mortgage Insurance. This can range from 0.55% to 2.25% of the total mortgage and would be a fee part of your monthly payment. This usually stays on your mortgage for 11 years or the entire duration of the mortgage, but you'd have to check with your lender to find the details out about that. You can remove it before 11 years by refinancing once you have 20% of equity in the property, and you can refinance into a conventional mortgage which doesn't have PMI. Now, if you want to buy an investment property, you'll need between 20 and 25% down payment on the property, and you'll also be paying a higher interest rate and have other qualifications required, such as monthly reserves, which is typically 3 to 6 months of the mortgage payment in your bank account for reserves. The second step is to check on your credit score. Know what your credit score really is. One misconception that a lot of people make, and even I made for a long time, was thinking that the scores that Credit Karma and other apps like this show are your real credit score. However, those are not actual credit scores. Those are just simulated credit scores based on your credit data. Banks use your FICO score, and on top of using the FICO score, they don't use the newest FICO score algorithms. They use FICO 2, FICO 3, or FICO 5 in most situations. These scores are generally less forgiving on negative impacts of your credit score. So the Credit Karma app could say that you have a 780 credit score. You can get these real scores from my FICO. I'll leave a link down below. However, you do have to pay for the service, but if you've had any problems with your credit in the past, then I would definitely recommend that you pay for this for the first month just to get an idea of where your credit score is before you start going out and applying for mortgages. This way you know upfront whether or not there's any work that you need on your credit score. And now the third step, saving money for your down payment. This is important to figure out early on because it can take a while to save up money for a down payment. So while you're working on all these other steps, you can be working on this one upfront if you haven't already started. And one thing to note is banks will want the last 2 months of your bank statement. So if you're thinking about applying for a mortgage in the next 2 to 3 months, make sure you're not making any large deposits that you can't account for. Otherwise, banks will completely disregard that money. Banks will want a paper trail of every dollar that comes into your account over $500 to $1,000. And this is something that could really mess you up if you're getting money from somewhere other than a job or a family member that you can't document. Now, going on to number 4, this one's pretty obvious, but you have to have employment. You need to be able to show proof of income. You could be employed or self-employed. Now, if you're employed, you'll need a consistent paycheck. If you're salaried, then you're all set. If your hours fluctuate, however, or you make a lot of your money through tips or bonuses or other commissions, then the bank will use an average of your income over the last 2 years. And they'll confirm this through W-2s and the latest pay stub. If you're self-employed, the bank will want to see the last 2 years of your tax return and use an average of your profit over the last 2 years. So if you have a small business and you're writing off a lot of losses, then that might be a problem for you qualifying for a mortgage, but you'll have to check with a local lender. Now, the next requirement for your job is you must have a 2-year employment history. Banks will want to see that you've had 2 years of employment at least in the same or similar field that you're in. The exception being if you just graduated from college in that 2-year window, you can use your college education to make up the gap of whenever you started working. So if you started working a year ago and you graduated just before that, you can use college as 1 year of employment history and then your actual job as the last year of employment history. And that will satisfy the 2-year requirement. And then the last income that you can use for qualifying for a mortgage is rental income from the property that you're buying. You can use 75% of the gross income from the rental property that you're buying. And this is how I mentioned before that I was able to buy a $570,000 property on a $40,000 income because of rental income that I was getting on the property I was buying. And moving on to number 5, get pre-qualified before you start looking for a property. This is to ensure that you're not looking at properties that are outside of your price range, therefore being heartbroken when you can't buy it. One important thing with getting pre-approved for a mortgage, make sure that you shop around and get 2 to 3 pre-approvals from different lenders. This will give you the benefit of being able to negotiate with other lenders and try to reduce or improve their terms of the mortgage. Sometimes banks will compete with another bank and give you a lower interest in order to get your business. And now some people might be concerned that having multiple banks run your credit will hurt your credit. However, it's actually encouraged by the credit companies to shop around and get multiple pre-approvals. So as long as you shop around between 30 and 60 days of each other, that will only count as one negative hard inquiry on your credit. So it will not impact your credit score by any more than just applying to one. And now, number 6, start looking at real estate deals. This is where you'll need to find a real estate agent in the market that you're looking to buy in. This will be important, especially if you don't know much about the market, because real estate agents have a lot of insider information and they can find out information on any property that you're interested in looking at. And they are also going to help you on putting offers in on properties and getting it under contract. And don't worry, you don't have to pay the real estate agent. The real estate agent is paid from the seller. And then you also want to make sure you're doing your own research on the area that you're looking to buy in. You want to find out all of the information about the neighborhood that you can. For example, before I bought my duplex, I spent probably 6 months doing research in the area. I made sure I knew what projects the city were planning in the area, major projects that would help increase the value of the neighborhood, such as, in my case, there was a $250 million shopping plaza that was being built in the next 2 years about half a mile away from my property. And it was upscale development, and properties in the area shot up by more than 3 times. The other thing for me is that I'm constantly doing research on areas that I'm interested in buying my next properties in. Even when I'm not looking to buy in the next 2 to 3 months, I have apps on my phone like Redfin and all these other apps that I get notifications of new deals. I look at real estate, I see what's on the market, I see what's being sold, I see how much they're selling for, I see all the trends. I know what's going on in the market as much as possible. So the next consideration for when buying, this is for mostly if you're not planning to live in the property. However, it's even more important if you are planning to live in the property. It's a good rule of thumb, if you wouldn't be comfortable living in the property, then you probably don't want to invest in it. And other people will probably feel the same way that you felt and may not want to rent it. So it might be harder to rent and you'll have to take less money in rent. One of the important parts with buying real estate is not overpaying. So I would suggest never buying a brand new construction property or one that's been completely renovated. There are some exceptions, being if it actually is a really good deal, then it would be worth it. In my case, for example, I had bought a property that had been completely renovated. However, it was definitely under market value and I knew the appreciation was going to skyrocket. So I knew I had to buy a property in that area, and that was the only property in my price range. So it is on a case-by-case basis, but generally you want to look for properties that need some cosmetic work. For example, maybe updating bathrooms or updating kitchens, or simply just painting inside or out. I would generally never recommend, if you're starting out, to buy a property that needs a full-blown renovation. However, if you think you can handle it, then maybe you can. And then the last point on this is take your time when you're buying real estate. Never get in and buy the first property that you look at, because it's probably not the best. You could look at 10, 20, 30 properties depending on how many are available in your market, but make sure to look through and find the best deal. Most properties that you look at are not going to be a good deal. So you have to know how to run the numbers, and your real estate agent can help you do this at first, but as you learn how this works, you can also start doing this as well. You want to check on cash flow, cash on cash return, all of these things you need to know as an investor. However, that's for a whole nother video. And the other thing to keep in mind is most of the time when you're doing renovations, you'll have to cash flow it, because generally if you're paying a low down payment, you won't be able to take any money out on the property because there isn't enough equity in the property. However, like I've been saying this entire video, double check everything with your lender, as some lenders have different loan programs or qualifications. And moving on to the 7th step of getting started, start making offers. This is the exciting point. This is when you start putting offers in on properties. If you're in a competitive market, you're likely going to put offers in on multiple properties and have multiple offers on each property that you put an offer on. So don't be bummed out if you don't get the first property you make an offer on. There's a few things to keep in mind. If there's a property that doesn't have multiple offers on it, or it's been on the market for a long time, maybe there's something wrong with the property that people have seen and don't want to buy the property for that price for that reason. So if you do make an offer on one of these kinds of properties, make sure you and your real estate agent make extra sure to check everything with the property and have a thorough inspection done before you get under contract. And going on to the next part of having inspections done on any property you buy, this is important because if there are any hidden problems like a foundation problem or any kind of electrical, plumbing, or any problem like that, your inspector should find it. And if it wasn't disclosed by the seller up front, you can either back out of the contract or ask for a reduction in price or concession at closing. And your real estate agent will help you along with this process as well. And then the last part of making an offer, make sure to ask the seller to pay for closing costs. This will help reduce the amount of cash that you need to close on the property and therefore decrease the amount of money that you need to start investing. This is a fairly common practice and sellers are pretty used to being asked to do this, so it shouldn't be a problem in most cases. And now that your offer has been accepted, you're under contract, you're on your way to close on the property. And this is step 8. Get your mortgage approved and close on the property. Now, since you got pre-approved, there should be no hidden problems, so this should be a pretty easy process. The only thing is to make sure you don't make any large purchases such as a new car or anything like that that could affect your credit or the amount of money that you have in the bank. Banks will comb over every fine detail the entire step until literally that last hour before you close on the property. So if you buy a new car, the bank is going to know about it and they could deny your mortgage. And the most exciting step, number 9, get your property ready to be rented out. Now that you own the property, this step will include making any final updates that may need to be made to the property, such as painting or anything like that, and then getting showings set up with your real estate agent for getting the property rented out. I definitely suggest using a real estate agent to get tenants. The real estate agent will be able to take care of all of the background checks, all of the income verification, all of the pre-screenings to make sure that you get the best tenants possible in your rental. And that's one of the most important parts, is making sure you get good tenants from the beginning. Otherwise, you could have a lot of problems later on, such as them not paying their rent or them just totally messing up the property. So make sure you use a real estate agent and they get you good tenants. And now you have successfully got your first real estate investment. Congratulations, this is a huge accomplishment. And now that you've got this far, number 10 should be easy: being a good landlord. So now that you have tenants in the property, it's important to keep them happy, and one of those ways is by getting things fixed in a timely manner. So making sure that you have someone that is able to take care of electrical, plumbing, heating issues, any issue that could arise. If you're not able to take care of it, make sure you have someone that can. It's important to get things fixed in a timely manner, especially if they're urgent issues. And this kind of goes into, do not be a cheap landlord. I don't want to go to your property and see duct tape holding things together that shouldn't be there. And this is what I personally do as well. I go above and beyond, even if it costs a little bit more to fix problems or make changes to the property. I go above and beyond. I want to make sure my tenant knows that I care about the property that they're living in, so that they take care of the property as well. For example, I replaced my thermostats with Nest thermostats just because it adds that next level of quality and appreciation for the tenant. And these little things do add up. Imagine if you're a tenant, what would you want your landlord to do for you if you had a problem? If it wouldn't be acceptable for you as a renter, then you should never let it be acceptable for you to do to your renters. And so there we have it. Now you're also a good landlord. Real estate investing is such an important tool for building wealth. So my goal is that this video has helped to make you a better landlord, a better real estate investor, and giving you some insight before you jump into the game about what to expect. So if you thought this video was helpful, I would definitely appreciate it if you liked the video down below, left a comment, and subscribe for more content like this. I will be releasing multiple videos every single week on real estate investing and finance related videos. So subscribe if those interest you, and thank you for watching, and see you next time.